When? When is the whole system going to crash? And if you read the Fed's financial stability report that came out recently, well, it talks about the financial system vulnerabilities. It talks about how rising rates exacerbate these vulnerabilities. What you can do to make sure that you are not vulnerable. When you're looking at where we're vulnerable, well, let's start by the asset valuations, because they tout how there was no inflation with all the new money that they created since 2008, because that inflation went into those reflationary, those are their words, not mine, those assets that were targeted for reflation. Stocks, real estate, bonds. Okay, so the asset valuations are extremely high. Economic uncertainty creates market volatility. Have we had some volatility? Yeah, I think so. Is that an indication? It's kind of like a bridge, right? Bridge is meant to take you from one place to the other place, and it's supposed to be solid. But have you ever seen a bridge during a hurricane where it's swinging back and forth and back and forth and back and forth, and at some point it collapses? And that's the volatility, and that's where we are right now. Financial asset prices remain high relative to expected cash flows. So what they're talking about here is that corporations, look at those fabulous earnings that I've shown you and profits from these corporations during this period of time, especially since 2020. And then house prices rising faster than even the rising rents. What you've been looking at is, even though the housing market is cooling off, the prices still were over 20% year over year on average. And in some places like Tampa Bay in Florida, over 35% increase in house prices. Now, you got to have shelter. That's part of the mantra. You've got to have a place to live and maybe a place to make your last stand. But, year over year, 20 and 30% price increases. Yeah, what goes up must come down. That's not happening yet, but I don't think we're that far away from it. The next sign that we should be looking at is borrowing by businesses and households, because that debt to GDP ratio is exploding. And throughout 2021, businesses and household debt continue to grow. They're expecting the consumers to keep us out of recession. Yeah, you beat the crap out of consumers. You give them some funny money so that they can kind of get through it, but was it really about helping the families survive what we're going through? Heck no. It was enabling them to continue to consume so the corporations could make record-breaking profits. The business debt to GDP ratio remains high, and increases in household debt were concentrated in borrowers with good credit ratings. So back in 2008, they were given to, a lot of the problem were subprime borrowers. Has that issue gone away? No. They have made getting credit easier and easier and easier. And as I've shown you over the last number of years, that the credit rating agencies have reduced their standards, that the banks have reduced their standards. So even when they're making these kinds of statements that the household debt were concentrated on borrowers with good credit rating, yeah, that's probably partly true, but it's not all the way true, because consumers must continue to consume if we are going to have any chance of keeping this whole thing going. And they're having a hard time with this inflation. Risk-based capital ratios declined at the largest banks due to market volatility. So that's not really good. It means that the banks are more vulnerable. But we're in an ample reserve environment, according to Fed Chair Powell, which means that we taxpayers are backing up these large financial institutions. And we sure saw how well that worked in 2008, don't you think? Leverage was high at life insurers and elevated at hedge funds. You know, a lot of people will put money into annuities. Annuities are issued by life insurance companies, and the ability to pay out that annuity is based upon the claims paying ability of the insurance company. And so a lot of people are counting on those annuities to help them through retirement. Maybe yes, maybe no. You know, it's all relative anyway, because whatever you get paid out, if you can't buy very much with it, doesn't really matter, does it? You take on this debt. That debt or the payments on that debt is then turned into a financial product and sold back to you in your retirement. Who's on the hook at the end of the day if these instruments go south? You are. Whoever is owning that is. Because the guys at the top, well, look it, they make money when they issue the loans. They make money when they turn it into a product and sell it back to you, and they get ongoing fees from it. So, you know, you're taking the risk, you're paying to take that risk, and you are the one that's going to be left holding the bag at the end of the day. I don't think that's a good deal. But here's the kicker too, and this goes back to the liquidity, and that's funding risk. So all of these are typical signs that you see just before a crash. So how close is it? Well, you're gonna have to determine that. Domestic banks maintain a high levels of stable funding. What is that stable funding? Deposits. Because even though your perception is that I deposit my money into my account and that's my money, no, that's not true. As soon as you make that deposit, the bank has the ability and the right legally to sweep that into sub-accounts in their names and then use your equity for their benefit. So again, it is simply your perception that you own something, but you really are just a beneficial owner. You own nothing. Ultimately, without a doubt, you will see gold outperform and then silver, everything else, because it has the broadest base of buyer. And that's what you really want. You go into an auction, there are 10 people, and on one table, you have 10 of the same thing, and everybody wants one. So wherever the bidding opens, that's what you're going to pay, and everybody walks away happy. But you have another table, and there's one, and all 10 people want that. Well, he or she who's willing to pay the most actually ends up getting it, but you still had 9 other people that wanted it, and that will ultimately most likely push those prices up a whole lot more.